Hey guys, you got Kobesy Trades from GuruHaven. I'm joined with Tavi Costa from Crescat Capital here to do a quick video review. No, it's been about a month or so since we did our last one. Wanted to put out a little holiday preview going into Thanksgiving, Hanukkah, Christmas that we have coming up. We were going to have Simple Trends join us as well, but he unfortunately had to step out last minute, so we will have a chart of his to look over as well, though. So, and with that, let's look at some charts that Tavi has been, looking at and eyeing as of late.
All right, thanks for having me. Yeah, on this first chart that we're going to be looking at is just corporate earnings for the Russell 3000, sort of a more broad way of looking at equities in general. My interesting take here is just looking at the corporate earnings, which has been contracting, but not just that, but it has the widest spread against inflation since the global financial crisis. So, corporate earnings are now negative. And while that inflation rates are actually higher than corporate earnings and the largest spread since the Great Recession. In our view, our macro indicators are signaling a recession ahead, and this chart illustrates very well this sort of imbalance of fundamentals and stocks at near record valuations. In our calculation, at least in 8 fundamental factors are at record valuations today. This is just another way of not just looking at the fundamental of equities, but also a source of liquidity. If you think about corporate buybacks and even just earnings in general is a huge source of liquidity. And as we get into the late stages in our view of the business cycle here, I think that this is a very important takeaway and puts equities in a very difficult position here for the following months or so. And I think if this continues, if we get even deeper here in a contraction of earnings, I think it would put equities in a very downward pressure here to sell off, and while we are at very extreme valuations that we don't think are going to hold up as we enter here a very tough and challenging scenario. In the next chart, it's another interesting takeaway with inflation, which today we have 100% of the Treasury yield curve essentially or is below the median CPI as well. In other words, all the yields from 30-year yields, 10-year yields, all the way back to Fed funds rate are now below the median CPI. And that's the second time in history that we have this situation. It actually happened in 2015 and in late 2015 and 2016. But today what we have is actually a very different macro environment that we had back then. Today we have median and core CPI at decade highs. We have a Federal Reserve that is already printing or have already printed close to $280 billion of increase in its balance sheet in the last 3 months. That's a 45% normalized growth. We have global central banks easing everywhere. And also, if we keep up the same growth in the balance sheet today, we're going to get to close to $1.1 trillion of new assets in the Fed's balance sheet, which is equivalent to the first QE in October of 08 that we had. And, just overlaying that whole thesis with the $15+ trillion of negative yielding bonds, we think that this makes a very strong case for precious metals. And it's another reason is also the how massively underallocated this large pension funds and so forth are in terms of precious metals in general, at a time when there's really no other alternative for a safe haven aspect of assets in general if we do have a downturn in the business cycle here. And where the opportunity lies ahead is in the third chart, which is just looking at the high beta version of gold, which is silver. So on the next chart, we have silver versus stocks. It's the ratio. And this opportunity is also given by, if you looked at the yield curve inversions, that we reached close to 70% of the yield curve in the U.S. was inverted, which the way we look at this is just looking at all the possible combinations of the yield curve in the U.S. in terms of 10 versus 10s, and 30 versus 10s and 30 versus 7s, all the way down to the Fed funds rate. And there's 44 possible spreads in the yield curve. About 70% of the yield curve got inverted about 2 to 3 months ago. If you look back in history, every time that happened, it preceded a recession or coincided with a recession. This time it's proven to be preceded a recession if the recession comes around. Now, what's really important here is not just that, is what are some of the investments that have worked throughout history when we reach such an imbalance in the credit markets. And one of the things we found is that if a person or investor would have bought gold and sold stocks, this ratio of gold to S&P 500 ratio at least doubles. The median performs that it doubles during periods of that we, and the first time that we reached this 70% inversion in the cycle, in the business cycle. So in this chart, we're just looking at as I said, a high beta version, so a more volatile form of this trade, but also, where we think there is a huge opportunity. It's very obvious there, showing a long-term chart of this ratio, and showing a very clear double bottom. And also what we think it's, very early stages of a multi-year bull market for precious metals. And at a time when we think the stocks offer, no value proposition whatsoever. The way we looked at stocks here is really selecting, not just shorting Russell 3000 or the S&P 500. What we do is really by selecting a basket of the most expensive stocks we can find using our quant models, proprietary quant models, and so forth. So that's one way that we do this. In terms of precious metals, there's so many ways you can get position for that, not just gold and silver, but the miners, in terms of mining stocks in general, look extremely compelling, the case for buying those here as well. So we believe in short terms, we believe that the economy is painted into a corner, and the opportunity here to be long precious metals and selling stocks is huge, and that's the way we think that it's going to play out for the following months or years.
Awesome, super interesting to hear, Tavi. And then I'm just going to jump in with a few slides myself, and to echo what you said with the Fed doing QE, although they will not call it QE. The Fed also this week, we've had Jerome Powell on Capitol Hill twice, and he was basically has repeated that they can't see them getting to the 2% inflation mark. I currently think that in the near term we could still be pushing towards a rate spike. I think you saw it start a week and a half ago, which I was calling for. And while we have dipped back the following days after just getting short of 2% on the 10-year, I still think this could be set for a decent move into the next December FOMC, which would likely cause them to cut when it's not really priced in, and they've stated multiple times that this is going to be a pause here. This is a key chart for me, as I've pointed out a few times in past videos and newsletters. And I think it goes right along the lines of what you're saying, Tavi. I mean, you want to see some similarities to the dot-com bubble and housing bubble. Basically, the last two times we've had rates rise from a drastic low and back test the 13 EMA monthly, and sometimes it overshoots as well and can hang up there for a few months. But now with electronic trading, I think everything's moving a lot faster. Expecting this to continue into the December FOMC, I think that would actually speed up the chances of a recession. Could it mean that stocks go slightly higher in the near term over the next month? Possibly, with an increase in rates. That'll also obviously hurt the bond market, and that in turn could hurt the junk bond market, which has generally tracked the equities fairly well. So seeing a dislocation, divergence between the two starting, and it'll be interesting to see if that's able to continue, or at some point does the increase in rates cause issues for equities and actually start to stall out before that meeting. And looking at Dixie as well, looking at the daily here, this is important to look at because as of late, what the currency world in terms of the dollar has been doing has been tracking rates, and typically this has been inversed, and this is actually a chart I'll show next that Simple Trends actually put together. But it looked like we had a breakdown, but we're able to hold the 97.20 level and put some bullish divergence in on the daily, as you can see with the RSI. that down here, and we're currently looks like we might have something very similar to mid to late July occur with a quick cross of the 13 and 50-day moving average. This could lead to a quick spike. I would expect something maybe to 99, and this like rates, since they're not correlated, I could see them also pushing higher into the next FOMC meeting, which is on 12/10 and 12/11 next month in December. And lastly, as I mentioned, this is actually a chart that Simple Trends put together. It's really interesting. This is the US dollar over the euro, and just compared with rates, you can see for the majority of the year, this has been an inverse correlation. And then more recently, over the past month or so, these two have synced up. So if you see strong dollar, that likely means you're going to see higher rates as long as this correlation holds. And typically in the past, as I stated before, higher rates could mean higher stocks at some point. Higher rates will not be able to be handled, by the credit markets. So it'll be interesting, something to watch. And the credit markets is something that Simple also talks about a lot and posts about a lot on our site as well. So that's what we wanted to cover today, just going through the quick presentation. And thank you a lot, Tavi, for joining. I think what you guys are doing at Crescat has been really interesting. You guys are putting out awesome information daily, and we really appreciate you joining. To everyone who's watching, if you haven't heard of GuruHaven, we're a community of traders. A bunch of us who are gurus are full-time and basically interact with a bunch of folks who are just generally interested in the markets daily and looking at charts and trying to figure out how to best position for upcoming months and how to best trade intraday if you're more active. So, and we like to have fun while doing all of that. So check us out. Our website's www.guruhaven.com, and follow us on Twitter, and we have newsletters that come out. And we have great folks like Tavi and a bunch of other people in FinTwit who are close with join that as well. So thanks, and we'll catch you at the next video review.
Thanks for having me. I appreciate it.